Crystal Van here in Phoenix. I am so frustrated. This keeps happening. I've talked about it before, but I'm going to bring it up again. I just had a couple more clients that this has happened to, where they went to the bank to get pre-qualified for a mortgage so they could buy a house, and they talked to somebody on the phone who says, "You are good to go. Here you go. Just go shopping, have fun, call us when you find a house." And then when we come back with a contract, the story changes. Yeah, not so much. I don't think we can help you after all. And that's the worst. That is the worst. So I thought I'd talk a little bit about what really happens behind the scenes, some of the inside scoop, so you understand why it is that on one hand, one day you're qualified and the next day you're not. Here's how it works. You go to the bank, your bank on the corner, and you go ahead and apply for a loan. And the bank on the corner, they make money by making loans. So they're more than happy to take your application. And they'll do whatever they can to help you. They're going to keep you online there until they can find a way to loan you the money. They make their money off of the initial loan. So they have their fees and things like that they charge. And once they make the loan, they've made their profit. But in order to make more loans, they need to now replenish their cash reserves. And how they do that is by selling that loan on the secondary market. And you've probably heard of that. Secondary market is a very popular term these days because the secondary market, how they make their money is off of the interest payments that are paid on the mortgage payment. And if the mortgage payment is not made, then they're not making money. And if the loan goes into default, they really are losing money. And so these secondary market investors have lost a lot of money lately. So the secondary market, now they have to decide which loans they want to buy and which they don't. And they have their own guidelines. Each investor has their own guidelines that they follow. Those guidelines are called overlays. So if the primary loan originator wants to sell your loan to them, the loan has to meet these other guidelines. So when you initially apply for the loan there at the bank, they'd love to help you because that's how they make their money. But they can't really give you the loan if they can't sell it on the secondary market. So the process of deciding whether your loan can be sold on the secondary market is called the underwriting process. And you've probably heard that term as well. That's where they do a very careful analysis to see if you meet those overlay guidelines. What's your credit? Do you pay your bills? What's your cash situation? Do you have good income? Do you have cash reserves? What's the collateral? Are you putting a down payment down, or do they maybe have to add in some mortgage insurance, or maybe charge you a higher interest rate because of the high risk? Those things are determined by the secondary market because they're going to be taking the loan long term. So basically, during the underwriting process, what's happening is the primary market, the loan originator, is asking the secondary market, hey, if we loan this guy the money, will you buy this loan off of us so that we can continue to make loans? And if you get the thumbs up from the secondary market investor, you're good to go. If they give you the thumbs down, you're out of luck, no loan. So what's going on now, of course, obviously, is these investors have lost a lot of money, so they're really tightening down those guidelines. The FHA, for example, they're tightening their guidelines to some degree, but the secondary market is tightening them even more so. So you may meet those publicized, everybody knows them FHA guidelines, but you might not meet the overlay for that particular bank. And every bank is going to work with a different group of investors, and you need to match the rules for that secondary market investor or no loan. So there's going to be a lot of people who are going to miss out simply because they went to the wrong bank. Bank A may be working with a group of investors that cannot help you, but Bank B may have some investors who can. So that's why it's really important to work with a mortgage professional who kind of understands these secondary markets, and they understand which banks can help you and which can't. Otherwise, it's like a needle in a haystack trying to find somebody who can help you. So that's kind of the scoop. That's what we're facing here. It's just going to get tougher and tougher, but that's the way it is. What can you do? So if you have any questions or comments, or if you're just really frustrated because you got turned down for a loan and you want to ventilate, shoot me an email at kristen@hereinphoenix.com. I'd love to hear from you. Make it a great day.